In this month's Economic Update, Kaplan Professional Education's Michael Pollock speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's monthly Economic Update. I'm Michael Pollock, and today we're speaking with Chief Economist at BetaShares, David Bassanese. Thanks for joining us today, David.
No worries, Michael.
Firstly, looking at Australia, what challenges for the RBA are the cutting of the cash rate to a record low 1.75% a reflection of?
Well, I don't really see it so much as a challenge as more an opportunity, because what they're basically saying is that inflation really poses no threat for the foreseeable future, so we can, although the economy is growing okay, can actually afford to do a bit better. The unemployment rate is still above its long-run sustainable level, so it's really a push for growth. I think it's basically saying, you know, we can afford to cut the cash rate and see if we can get the economy growing at above trend pace. So it's actually quite good news rather than a sign of negative news, really, in my opinion.
What are the potential risks of Australia running a relatively high budget deficit of 4% of GDP and projected deficits out to 12 years?
Look, sustained budget deficits, I guess, are obviously a risk. I mean, the rating agencies have already suggested there's a risk of a downgrade unless we show a path back towards surplus. But again, I think a good chunk of our budget problems are growth related. I mean, the Treasury Secretary has said as much. If we can get growth back above trend and put downward pressure on the unemployment rate, we can really make decent inroads into the budget, as the forecasts do show. I'm still counting on the economy to do a lot of the heavy lifting in terms of getting the budget back into surplus over the next 5 or so years.
Do you anticipate the government implementing any fiscal measures post-election to help lift inflation?
Yeah, look, there's a lot of talk about the government using fiscal policy more and relying less on monetary policy, but I guess the backdrop is that they are still worried about the budget deficit in the short run, so I can't see a lot of net stimulus spending apart from, say, outside of the infrastructure area, and they have, the government's announced a policy whereby they'll sort of use their balance sheet, offering possible guarantees, these sort of things for infrastructure projects. So I expect to see some innovation in terms of off-balance sheet financing, which won't necessarily raise possibly our absolute level of debt, but in terms of contingent liabilities, let's say it may be increased. But some more innovative forms of helping fund infrastructure may be one of the things to look for with the new government.
How sustainable do you expect the recent rebound in the iron ore price to be?
Look, I'm not too confident on iron ore prices. I think most fundamental economists that look at the markets see it as it's basically gone too far, too fast to the upside. I think there's a couple of when you look at it, there's one fundamental factor. There's been some uplift in the Chinese property market on the back of some credit easing, but the overall Chinese steel production is still contracting. There's still net supply of iron ore is still expanding. We know the marginal cost of production amongst the major miners is a lot lower than $55, $60. And so they'll keep expanding at prices these high. So I still basically see a supply-demand imbalance that will bring prices back down again. Maybe we have seen the lows. Maybe we don't break through $30 or $25. Some of the more pessimistic forecasts of last year. But certainly at these levels, I think there's a lot more downside than upside.
So, David, what's your overall outlook for the Australian economy for the remainder of 2016?
Look, I'm getting a bit more confident about the economy actually on the back of the Reserve Bank interest rate cut and potentially another one, if not 2 rate cuts over the next 6 months to 1 year because of their quite low inflation forecast. The RBA is now looking at underlying inflation at 1.5% till the end of the year and only rising to 2% by mid-2017. So they can really afford to go for growth. So maybe the housing sector stays stronger for longer. Maybe we get some more business animal spirits coming back into the corporate sector and a better upturn in the non-mining sector investment, which has sort of been sluggish. I think the Aussie dollar is going to come back down again, back under 70 cents, and support the sort of trade exposed sectors. So I'm just looking at growth. It grew 3% last year, and probably there's a good chance it could grow 3% through 2016 as well. and that we should be able to grow even stronger than that. So so the RBA basically supporting growth, I think is going to be a positive.
Turning to the US, what's your view on further rate hikes this year, given recent weakness in the economy and the persistently low oil price?
Yeah, look, there's been a standoff in the United States at the moment where the Fed has been talking about 2 rate rises this year. The markets really don't believe they're going to do one. There are signs of weakness in the economy, but at the end of the day, the economy is still growing. Unemployment is still quite low. There are signs that wages are starting to pick up in the US. So I think the onus is going to be on the Federal Reserve to basically continue with what it said it will do and raise interest rates. So June's looking dodgy now, but I would still be seeing at least 2 rate rises this year. Maybe not June, but maybe September and later this year. So I definitely think the market has to price in eventually higher US interest rates, though that's not a risk anytime soon.
What's your near-term outlook for the US dollar?
US dollar should really be, I think, at the moment it's an ugly it's a so-called ugly contest. Which country is faring the worst? And at the moment, the US is not doing great, but it's doing better than say Japan and Europe. It's still, as I mentioned, on the back of the Fed raising interest rates, policy remaining on hold, and potentially more quantitative easing in Europe and Japan. You've got to figure that it's the US dollar that's going to be going up. So I'd still be a US dollar bull, and obviously that would mean that the Aussie dollar, on the back also of commodity prices correcting back, would probably break back below 70 cents eventually.
So what will be the drivers of the US economy throughout 2016?
Yeah, look, low interest rates holding. The 2 big drivers of the economy at the moment are consumer spending, which is an important part of the US economy on the back of weaker oil prices and continued pretty good employment growth. And the other driver is the home building sector. So you've had an upturn in housing over the last few years after obviously the massive downturn during the GFC. So those are the 2 major drivers. The big negative for the US at the moment is the cutback in oil and gas sector on the back of weaker oil prices. So business investment, certainly in those areas, is correcting. So that's going to be a drag on the economy. But overall, it's still chugging along reasonably okay, I think.
Looking at China, what are the major factors contributing to the lower projected growth figure of 6.5 to 7% for 2016?
Yeah, well, basically, as in Australia, China is undergoing its own form of transition. So the industrial sector, mining, manufacturing are basically under pressure at the moment. So that's the major drag on the economy. And the so-called new economy, as we like to describe it here, but in the case of China, services, consumer spending are basically taking up the slack. But the big I guess drag on the Chinese economy at the moment is the ongoing rationalisation in the industrial sector, the overcapacity, plus just the general loss of, I think, price competitiveness that China is facing in global markets. So once the export powerhouse that it was is sort of retreating somewhat.
What risks do increased capital outflows and the subsequent depletion of FX reserves pose for the Chinese economy?
Look, I think one of the risks, certainly if the US dollar resumes its ascent, the way the Chinese currency is at the moment, it would basically follow the US dollar up, and so it would appreciate against other currencies at a time when the real exchange rate in China is quite high already. So the pressure, I think, is on potential devaluation, and a potentially large devaluation in China. If capital outflows continue and there's a resource, the reserves are run down and the US dollar is rising, so that is a big risk. And we saw late last year how markets can react to a surprise change in the Chinese currency situation. So it's certainly something to watch this year, I think.
So which sectors of the Chinese economy do you think will outperform for the remainder of 2016?
Look, I guess the so-called new economy of China, the retailing sector, the consumer sector is doing quite well. The business services like financial, insurance, those sort of sectors are really doing well. So you look at US companies doing business in China, and they're talking about quite good demand. They're consumer-orientated companies, so certainly those are the sectors to be focusing on, and the industrial, the old world, so to speak, in China is the one facing all the pain at the moment.
Just a question on Japan. With the concurrent recent rise in the yen and decline in business conditions, what's your outlook for the country for the remainder of the year?
The Japanese economy is actually not doing too bad. It may sound surprising because people focus on the deflation there, but I mean the unemployment rate in Japan has been trending down. It's actually now below its long-run average level. Business investment has been picking up. It's benefited from the weaker yen. Now the yen again is a risk if it appreciates as it's done the past few months, but I think it's going to be the US dollar going up mainly over the remainder of this year, and the yen weakening, which will be supporting their economy. So I actually think the Japanese economy and the share market will do okay, but I don't think they're going to solve their deflation problem. I think that's sort of endemic in a basically economy where potential growth is quite low anyway, with population ageing and what have you. So they won't solve that problem, but I don't think it'll stop the economy still doing reasonably well.
And finally to Europe, what would be the major ramifications should Britain actually exit the European Union?
Well, what the businesses of the United Kingdom are fearful of is, they'll be shut out of the European markets, which obviously is a major trading partner. Well, not necessarily shut out, but they won't get the preferential trade access that they get at the moment. So a lot of trade deals would need to be renegotiated and create a lot of uncertainty in the short run for the UK. So that's the major, I guess, risk for them. There are, arguably there are some, they could be freer of some European regulations were they to exit, so there are swings and roundabouts, but I guess I'm in the camp that net it would be a bad move for the UK to leave, and certainly a lot of short-run adjustment problems should they make that decision. What
are your expectations overall for the European economy this year, given the failure of the ECB's QE program to lift inflation?
Yeah, look, Europe's a little bit like Japan in this case, because both central banks in Japan and Europe are trying desperately to lift inflation, all to no avail. So they're basically, with the quite aggressive quantitative easing policies, negative interest rates. But their actual economies, the real side of their economy, has been doing okay. Europe has been gradually recovering over the last few years. Albeit, there's been some hiccups with the problems with the sort of, the Greece and Italian debt problems. But the core economies, particularly Germany, has been doing reasonably well. I think I still see that as continuing on the back of what I think will be a weakening currency against the US dollar. So that's going to help. But also weaker oil prices, weaker commodity prices are beneficial to European consumers, and Europe in general is a net commodity importer, so they benefit from weaker commodity prices, particularly oil. Again, we're not talking about fantastic growth in either Europe or Japan, but reasonable by given the potential growth in those regions.
Thanks very much, David.
No worries. Thanks a lot, Michael.